Let's jump right into this explainer. The disciplined investor avoiding emotional pitfalls in crypto. Picture this. It's 2 a.m. You're wide awake, staring at the ceiling, just bathed in that harsh blue light from your phone. You're scrolling, and then, boom, an alert flashes. A trending post. Your heart actually skips a beat, right? You know that feeling. It's that creeping, heavy anxiety of missing out on something massive.
Bitcoin is up 15% today. It always starts with just one headline. At first, you think, okay, whatever, I'll ignore it. But then you open your feed. Literally everyone is talking about it. Videos everywhere are screaming that this is the absolute opportunity of a lifetime. Forums are just completely overflowing with screenshots of completely regular people turning a few grand into hundreds of thousands of dollars. And it doesn't stop. Bitcoin keeps climbing. Ethereum is right on its tail. And suddenly, meme coins are making these unbelievable, almost comical gains. Out of nowhere, your buddy who has never cared about investing a day in his life is suddenly a crypto expert. A coworker casually drops that they doubled their money over the weekend. Honestly, the fear of missing out, the FOMO, is absolutely suffocating.
And all that suffocating FOMO? Well, it leads us straight to our first major roadblock. Section 1. The ultimate crypto myth.
The real problem here is making the wrong decisions at the absolute wrong time. That intense psychological pressure plants this really dangerous little thought in your head. Wait, what if I'm too late? So, you jump in. You just pull the trigger. But you're not doing it because you've deeply studied blockchain architecture, right? You're doing it because everyone else is getting rich and you want a piece of the pie. People will literally spend days agonizing over finding the perfect coin. But here's the kicker. The real problem usually isn't the asset itself. It's the timing. That single emotionally charged decision to jump in just because of FOMO. It wipes out billions, yes, billions with a B, every single market cycle. It's just a staggering amount of wealth destroyed, not because the technology was bad, but because unchecked emotions took the wheel.
So what's actually driving this? Two primal, incredibly powerful forces. Greed, which convinces people prices will rise forever, versus fear, which convinces people prices will never recover. When prices are skyrocketing, greed is in total control. It literally tricks the human brain into believing the line only goes up. But then, the market crashes, and fear takes over entirely, convincing people that prices will absolutely never, ever recover. Because beginners let these two emotions drive, they inevitably do the exact opposite of what they should. They buy in near the absolute top when greed is blending them, and they disastrously panic sell at the absolute bottom when fear is at its peak.
Let's actually look at how this plays out in the real world. Section 2. The 2021 bull market collapse.
$69,000. That was the massive euphoric peak Bitcoin hit back in 2021. If you were around for that, man, you remember the vibe. Everyday investors felt completely invincible. There was this palpable energy, this crazy belief that the crypto market had somehow just defied financial gravity forever. It was a time of unprecedented, wild optimism. I mean, everywhere you looked, financial influencers were boldly and, as it turns out, pretty blindly, predicting a straight shot to $100,000 without a single bump in the road. Thousands and thousands of first-time investors poured their life savings in right at this exact moment, completely convinced they couldn't lose. The greed was just deafening.
But here's the reality check: inflation and rising global interest rates. Markets just don't move in straight, unbroken lines forever. Eventually, macroeconomic gravity always kicks in. As global interest rates started climbing and inflation spiked, big investors got cautious. They started pulling their cash out of risky assets, and crypto, it fell off a cliff. Within just a few months, all that hype was totally crushed, and Bitcoin lost more than half of its value. All those new investors who bought in during peak excitement, they were forced to sit there and watch their portfolios absolutely collapse.
And honestly, that crash was just the beginning. That brings us to Section 3, some of the darkest realities of this space. Catastrophic failures, specifically Terra and FTX. This wasn't just your standard market dip. These were high-stakes, devastating collapses of ecosystems that people thought were completely unshakable. Just look at this timeline. Over a few months, billions, literally billions of dollars flowed into Terra's high-yield ecosystem. It promised incredible stable returns. But in just a matter of days, the system completely unraveled, and those billions vanished into thin air. Poof, gone. And then, as if that wasn't enough, came the FTX shock. Over several years, millions of users trusted FTX. It was one of the biggest exchanges on the planet, backed by huge investors and A-list celebrities. Yet practically overnight, the whole thing collapsed into bankruptcy, and regular people woke up to find their funds entirely frozen. Poof, gone.
Blind trust is never a strategy. That's the brutal lesson here.
It wasn't necessarily that the underlying blockchain technology failed, it was the catastrophic consequence of blindly trusting the hype. It's that really dangerous assumption that just because something is massive, endorsed by a celebrity, and going up in price, it must be safe. When you swap out critical thinking for blind trust in any financial market, you're going to get burned.
So, how do we avoid all this? That brings us to a very sharp pivot. Section 4, the Professional Investor Playbook. We are leaving behind the chaotic, deeply emotional, and honestly disastrous behavior of beginners. Professionals operate with this cold, calculated discipline. It's exactly what separates true wealth builders from people who are basically just playing a digital casino. Let's break down the rules. First, and this is absolutely crucial, never invest money you cannot afford to lose. This protects your baseline survival. Second, diversify and spread your risk. Don't bet your entire life savings on one random meme coin. And third, ignore the hype. Professionals know this secret. If everyone is talking about the easy money around the office water cooler, that easy money is already gone.
So how do professionals actually do this? They use specific, emotionless tools like dollar-cost averaging, or DCA. Basically, it means investing smaller amounts consistently over time rather than dumping one massive lump sum in at exactly the wrong price. It is a brilliant strategy. Why? Because it mathematically reduces the huge risk of buying right at the market's absolute peak. It completely removes the sweaty palm panic of trying to time the market and replaces it with just cold, automated discipline.
And that discipline absolutely extends to knowing exactly how to exit. While beginners are agonizing over what to buy, professionals establish a rock-solid exit plan before they even invest a single dime. Step 1, determine your profit targets. Step 2, set your acceptable loss limit. Step 3, execute the plan without emotion. You have to have these rigid boundaries in place. It is literally the only way to prevent yourself from panic selling during a terrifying crash, and it keeps blind greed from holding you in the market way too long during a massive rally.
Which leads us perfectly into our final takeaway for this explainer. Section 5, discipline over hype.
Long-term wealth is built by the disciplined, not just the smartest. We really need to ground ourselves in this truth. Crypto is not some magical get-rich-quick machine. Yes, it's a market filled with incredible, totally unprecedented opportunities, but it also comes with severe and sudden uncertainty. The ultimate takeaway here? You do not need a genius-level IQ to succeed in this space. What you need is an ironclad temperament. True lasting success comes from ignoring the flashy trends, tuning out those loud influencers screaming on your feed, and keeping your primal emotions, fear and greed, completely out of the driver's seat.
I'm going to leave you with one final thought. The next time you see a coin that's already up 500% and you feel that familiar rush, your heart starts racing, stop. Don't ask yourself how much higher it can go. Take a deep breath and ask yourself this instead. Am I investing because I've actually done the research or because I'm just afraid of missing out? Use that exact question as a permanent mental safeguard. Honestly, it could literally save you thousands of dollars. Because the biggest mistake isn't buying the wrong coin, it's letting your emotions make a decision that your future self is going to deeply regret. Keep your discipline, stay focused, and I'll catch you in the next explainer.